Welcome, everybody, to our podcast where we talk about real financial problems with real people and talk about real solutions. I am Irene Meyer.
And I am Philip Villanueva here to bother Irene Meyer all morning.
Oh,
How is
great.
everyone today? So, Irene, question for you. This season is ending, it's almost ending a specific season of the year in the financial world. What season is that?
Financial world or financial country?
Our financial world.
Okay. If we're speaking about the same thing, and I corrected with the financial country in Canada, we have what we call RRSP season, and that ends on March 3rd this year.
Now, what do you mean by it ends? It just disappears?
What a great question. This is really good. Just a background as to why it even exists. The government allows for Canadians to contribute to their registered retirement savings plan for the previous year so that when we do our income taxes, we have the ability to reduce our taxable income a little bit more with our RSPs. And they always give us the first 60 days of the year to do that. So for instance, if I was going to do my taxes for 2024, realize, oh, it would help if I put some money into RSPs, I can still do that, assuming I didn't hit submit on my submitting my taxes, but I can still do that knowing that I have up until March 3rd of this year to contribute for 2024. So I hope that makes sense. They only give us 60 days in the first part of the next year to do that and still contribute for 2024.
So you mean what you mean by ending is for our tax reporting for the previous year. It's our ability to use RSP contributions. That opportunity ends March 1st.
Yeah.
Okay. So when you say contribution, so you're saying if we're putting money into our RSPs, we can claim that on our taxes. As what are we claiming that as?
We're basically saying that we're going to take this income that you've already taxed on us, government, and we're going to put it into our retirement savings. So you have to give us that tax that you taxed us back on that. So we're reducing our income on paper so that if we qualify to get some tax back on that money, because they can't tax us on that money. And that's what in Canada anyways, how it works.
So the idea of it is if we've already been taxed on this income, so what we're hoping to do is put it into an RSP so they can't double tax us until a later date.
Yeah. And when you say double taxes, basically so that they give us the tax back. Because there are some instances where, let's say, you put money into an RSP, and some people don't, most of the time, actually work this way. Okay, they don't do their taxes, like preliminary taxes, and find out, ooh, I have to pay taxes. I didn't pay enough taxes. I should put money into RSPs. Most people just put money into RSPs and then hope to God that it reduces their income and hope to God that they get a tax refund.
I guess the idea, and I'm glad we can edit this, is okay. So you were saying that people contribute into taxes and they just do it. Like people, they've thought they saw a commercial on TV and they're like, oh, I'm going to start an RSP. They have really zero idea as to why. So they're just doing it, and they go to an institution and they say, they go to a teller and they say, I want to start an RSP. They'll say, okay, we'll book an appointment with an advisor. 300 years later, you meet that advisor. Okay. Right. And then they'll give you what's called a risk. Everyone will have to do what's called a risk profile. And what that is just to say, okay, what's your risk tolerance as a consumer? How scared are you? And that's just to cover us as advisors to make sure that we're not putting you in something that you may not be comfortable with. We still should give you the options if you want to step outside of your box and work outside of your comfort zone. We should still give you that option. Let's say your profiler says that you're a scaredy cat. Like people, it's your money, but you might say, but I want this thing to really grow. Okay, so we'll give you the option of a little bit more of an aggressive profile, and you can choose whether you want to do that or not. So that's still always your option, by the way. So you do that. And then they say, okay, how much do you want to contribute to your RSP? Because that's typically the next follow-up question, as opposed to giving you advice as to what should really be done. They'll just say, how much do you want to put in? And you not really knowing how much you should put in will say, I want to do $50 a month or something like that. Right. So you do that. You start putting $50 a month into your RSP, and then it just keeps coming out every single month. You really have no idea what it's doing or how it's doing. Or after you did it, you forgot about it. It becomes the norm that it's just coming out of your bank all the time. That pretty much sums up everybody, right?
Yeah.
Okay, so now, what is the purpose of having an RRSP? What is the actual purpose?
The actual purpose and the reason why it came out in the first place was for Canadians to save on their own and give them incentive to save on their own. Over a couple decades, maybe even 3 decades ago, Canada realized that, hey, we may not have enough money for Canadians to retire on this thing that we call this pension fund that we've been doing. We need to incentivize Canadians to be able to retire comfortably by saving on their own, because this is not going to be enough, right? And so in order to be able to incentivize Canadians, they said, hey, look, we're not going to tax you on this money if you put it into something that's called what we call a registered retirement savings plan. And then everyone is given kind of limits based on their income and other adjustments. And that's how the RSP came to be.
Okay, so the government incentivized us to start saving money by saying we're not going to tax you on that money.
Yeah.
Now, do they ever? Just when they feel like it?
They tax us whenever we take it out of the RSP, because of course they want to just deter us from taking money out of RSPs before retirement. And then when we retire, it is probably assumable that our tax rate, like our marginal tax rate, is going to be lower because we're not working anymore. So when we take out the RSP, they're going to tax us at the rate when we retire, which is a
Yeah.
lower tax rate. So that's where the tax savings is. Now, talking to an advisor like us, where you can talk about how that works and what your forecasted, I guess, now we're not tax specialists, but we can almost show you where you can really be tax advantaged, or we can refer proper tax specialists for you and how your RSPs might work. Because some people, they have this, and I guess it's not necessarily a misnomer because it could happen. You know, that whole, oh, well, I hate RSPs because I'll get taxed twice. And I think people think that because they were already taxed, which they're right. But then when they did their income tax, they would have gotten a tax return, assuming that they were paying enough taxes in the first place. So it has nothing necessarily to do with your RSPs.
Yeah.
So let's say that you got a little bit of a tax refund and you say, oh, RSPs are the best. And then people think that they get taxed again. Yeah, because you don't quite understand that this was just deferring taxes, not avoiding taxes.
Right,
It was
right.
deferring it because, and again, it's assumed that when you're 71, which by the way, you are now forced to start taking money out of your RSPs when you turn 71 in the December, in the year that you turn 71, the government will say, okay, you have to start taking money out of this thing that we call an RSP, and there's a minimum. But your advisor can help you figure that out. It doesn't really matter at this time. So that's where they start to say, okay, we need our tax now. But again, it's assumable your tax rate is a lot lower than it was when you were working.
Yeah. And by the way, your advisor can help you set it up so that you don't have to sit there and every single month say, I want to take some money out. They can set it up so it's an automated system and the proper amount's going to come out every single month. That can all be set up and arranged. The whole idea is an extra source of income down the road. And I'm glad you touched on that idea of when that time comes, a lot of people are in a position of lower income because you're now retired, so you're not working, and there's a possibility of being in a lower income bracket. At that point, your taxable income is less. So this extra income from your RSP is not going to be taxed as heavily as, let's say, now while you're an employee, you're fully functioning, you're employed, and all this kind of stuff. Because I did get posed that question: why would I put money into an RSP? I'll just put my money in, I'll just save my money because I'm just going to get taxed on this extra that I'm making. So I had to explain to them that idea of right now, because you're making so much, you are going to get taxed on things if you take it out. But exactly that, down the road, you're not going to be doing the same career. Things are going to be slightly different in your life. So at that point, the extra source of income that's going to be taxed less is going to be helpful. Is the idea. And you also touched on like when you're putting the money in, it may not affect your taxes currently, right? Because the government of Canada taxes everyone at certain tax brackets. You're depending on your income, you're in a certain tax bracket, right? So depending on if you're in bracket A, B, or C, or whatever, that's going to depend on whether your RSP contributions are actually going to affect whether or not it's going to reduce taxes or not. So that's something else that, maybe an advisor is wanting to help with, because let's say somebody's in a tax bracket where contributing to an RSP is not going to affect them at all. As an advisor, what would you do?
No, there are other ways to save for your future if an RSP isn't necessarily the most optimal and going to help you today with your taxable income. We have the tax-free savings account in Canada where, although you're still taxed on it, like it's already taxed money, you can have it grow, tax sheltered. And when you take it out later in retirement, it's totally untaxable or not taxed. And there's that option. Now, the disadvantage with that option is that it only came out in 2009. 2009, and some people who are born after that may not have much of a limit, but that shouldn't deter you because at the end of the day, you still have a lot more years to work. So that shouldn't matter. So anybody who was an adult in 2009, meaning 18 years of age, you're totally missing out if you're not at least taking advantage of the tax-free savings account for your retirement. So for those of you non-believers for RSPs, tax-free savings, if you're not, no, you can totally save. I should say this, you should invest, not save, into your tax-free savings account, if anything at all.
Yeah, 100%. And you're right. This is why it's so important to have a professional working with you, because they do know your options, right? A lot of us don't know our options, but a professional should. And they can give you that guide to say, this is how you're going to optimize your investments, and vice versa. The investments should be investing back into yourself. There's advisors out there that are trying to invest into them as opposed to the client.
There's another option, and I don't know if this is where you were trying to bring me, Bill, to help save your future or your retirement. This is pretty special though, and it's probably more for the, I don't want to say sophisticated, but that's the only word I can come up with, but maybe the people who have pretty good income, see the value in saving for their future and just want other ways to save tax-free. And I say it's a special way, another strategy, because not everyone can qualify for the ability to invest or save, but invest more or less into an insurance retirement plan.
Yeah, those plans, yes, you do have to qualify in a sense, but you also have to have something in place to set this up. So that's the general public, you don't necessarily have to be the sophisticated one, but the setup is a little bit of a sophisticated explanation and sometimes a tough thing to grasp. But it's just like the idea of an RRSP where it's a tax deferred system. So you're not paying your taxes yet, but at some point you will. There's a possibility, and there are avenues around that as well. But again, that's something that we would talk to an advisor about. Now, in regards to the RRSP, so let's say I'm at that point. Christmas is around. I get my Christmas bonuses and my Christmas raises and all of that kind of good stuff. My next raise is going to put me over into the next tax bracket, right? Let's say, right? It's going to do that to me. I'm going to see my tax accountant and they tell me that I'm going to have to pay this year, let's say $5,000 or whatever. I'm going to have to pay $5,000 this year on my taxes. Okay, so I've been contributing though, but I still have to pay $5,000. So that doesn't make sense to me.
Again, like it takes into account ask that again.
Okay. If I've been contributing my RSPs all along,
yeah,
I didn't have to pay taxes last year. I did get a raise, but now all of a sudden I'm having to pay taxes. But I've been contributing, so why should I have to pay taxes?
So the question I think I'd have first is, did you also increase the amount of your RSPs?
No, I did not, ma'am.
Then that's probably one of the things you want to take a look at, because of course, if your income brought you to the next tax bracket, then you're paying more in taxes without investing more into your registered retirement savings plan, because they go hand in hand when you're thinking about trying to defer taxes. So I would encourage you to take any kind of increase you have, and this is good for your future too, any kind of increase, which you weren't even counting on, hopefully, to begin with, and just increase it either relatively to the amount that you got for a raise, at least, or throw all of that in the RSPs, of course, if you have the contribution room to do that. Or then again, if you don't have the contribution room, put it into your TFSA. Now, I'm also thinking that if you're doing it through your employer, it would make sense because they probably have a matching program. I would go there first. But if you don't have anything through the employer and you're just putting money into RSPs like through your advisor, then any kind of extra money you get, because you've already learned, or hopefully you've been accustomed to living on the kind of income you were before the raise, you can afford to put this extra money into, but if we're just talking about tax wise, then at least put it back into RSP.
But that's weird because my banker never told me I should put more money in. Like I set this
They
up at
would
the
never,
bank and I never got a notice. So I'm
again,
like,
they don't know when you get a raise.
okay, yes. So now I have to file my taxes. I don't want to pay taxes. So what do I do? I didn't put enough, obviously. I didn't increase my contribution. So what can I do?
You already filed your taxes then?
I haven't filed, but my accountant's saying I'm going to have to pay if I do file right now. So I'm trying to figure out ways to reduce how much I have to pay into my taxes if I do submit this.
Are they not giving you advice on what to do?
No, they asked me if I had an RSP. I said yeah, but that was as far as the questioning went.
Leave that accountant. Just kidding. That's why you guys shouldn't rely on your accountants for financial advice, just so you know. I don't know what you're trying to get at. Ask your accountant for advice, and hopefully they give you the advice that I just gave you, and we would consider reducing your taxable income.
I have till March 1st to contribute. I haven't filed yet.
Yeah, first.
Yeah, but I didn't put the money into my RSP throughout the year, so I spent it, right?
Have you heard of an RSP loan? Unfortunately, the advisor may not be able to help you with the loan itself, but borrowing to invest into an RSP. That's more of a banker question.
Like you can borrow money to put into an RSP.
Yeah, but you better work fast.
Yeah,
Okay.
today is the last day.
But let's say you have a few days, okay? And
Right.
it's the deadline is a few days away. Yes, obviously. So when I worked at the bank, we had this thing called the RRSP loan, where you literally, people who didn't have the money to put money into RSPs, but to avoid a tax bill, they would borrow money from the bank, do a lump sum. So let's say $1,000 was enough to get you so you don't have to pay a bill at tax time. Go to the bank. It's usually instant. Where they do the RSP loan. They actually, in some cases, now this is back when I was at the bank, it was instant. You didn't have to pull a credit bureau. It was instant for small amounts like that. And then you have the year to pay it off. So they only give you a year to pay off this $1,000 loan, but that $1,000 would go back to investing into an RSP.
Is it through the bank, or is it just the banks that can do that?
Yes, because banks will typically do small amounts like that, and usually it's fast on the spot. So I remember being so busy around that last week of RSP season. People's like, oh, I need to get an RSP loan with that too. So not only would I have to do a credit application, but I'd also have to do the investment for the RSP. So we're always busy. But if you're just like, I wouldn't go to even an investment advisor or a financial planner. They might have connections to lending institutions. They normally do not want to spend time on $1,000 loan. They're going to spend time on like tens of thousands of dollars on loans. But bankers, that's what they had to do.
Okay. Now, are you aware that insurance companies can do that too?
But not on the RSP.
Are you sure?
They might have connections, but they wouldn't do it.
Yeah. Yeah, because I know IA is heavily promoting the RSP loan.
Oh, are they like the lender though?
I think so, yeah. Yeah, I'm pretty sure they're the lender. You can apply for an RSP loan through IA. And
Oh, yeah, they do RESP loans too.
yeah.
Yeah, but the disadvantage with maybe institutions like a bank is that you are required to invest with them. I can't go to BMO, a bank here in Canada, a reputable bank here in Canada, go for the RSP loan, and then take that $1,000 and go to a different institution for their investments. I have to invest at that bank.
And that's the thing. If you've got your investments elsewhere, you got to be careful of where you're getting this RSP loan or applying for it anyway. And that's where, again, having an advisor can maybe give you guidance that way. Okay, so I've got this loan and I'm putting it towards my RSP contribution. So like you said, I still have to, now I have to pay extra to pay off this loan. Okay, so why would I do that? The reason why someone might consider doing that is really what's the offset? What are you saving on the taxes, right? Because what is the whole purpose? Why are we all trying to save on taxes? Because we want to have an extra source of income coming in, right? Instead of having to pay out, it's extra money in our pockets. Okay, people, why do you want extra money? Please don't say to spend it. Okay, the whole purpose of getting extra money is because now you don't need it. You're living your life. You're doing everything you want to be doing, unless there's a specific purpose. You use your taxes because the income tax return is what you use to take your annual vacations. Okay, that's great. But if it's now I'm gonna go to the movies, or I'm gonna do this, I'm gonna do that extra and whatever. I'm gonna go party up this weekend because I got my income tax return. Okay, people, understand this. Go ahead, spend all your money all you want. I can't pay my bills. Let's reflect. Okay, so now you're getting this income tax return, right? Because you got an RSP loan. Yes, you are gonna have to contribute to that loan and pay it off, right? But why don't you take the money that you have just saved on your taxes and invest it? Right? You got the money. You now have received a tax return as opposed to having to pay into taxes. Okay,
Right.
so don't just blow that tax return. Think or talk to your advisor. Say, hey, listen, I got my tax return. This is how much I got. What do you think would be the best course of avenue to maximize my earning potential? That would be your best course of action, because then your advisor could say, okay, you made this, that's great. Okay, let's do this part of it. You're going to want some spending money. Let's do certain percentages and then calculate everything out. They can help you out, and you put some into your investments. That amount now that you just saved on taxes is now growing passively, right? As opposed to being spent by somebody else, being spent and somebody else taking your money, because it's all good that we avoid the government taking our money, but why then are we so willing to let other people take our money? We're fighting so hard for the government not to take our money, yet we're okay with everyone else taking it.
Yeah.
So let's think about that. So now you're investing that money. If you would have had to pay a couple grand into your taxes, but now over the course of a year, you've just made a couple grand by reinvesting it, then it's all worth getting that loan.
Yeah,
Right?
totally.
So think about that, people. If there's a way where you can defer your taxes for the now, and then that whatever you saved on that tax, you can reinvest back into yourself.
Right.
And that's something that's really important. How do I make all of these ways of saving and investing back into myself, right? How can I use these things as a circuit to work with each other?
And there's all these different ways that you're actually limited, sorry, but you're limited at financial institutions like the banks. Because, for instance, we mentioned something like an insurance plan to be able to help you save tax-free. And not only will it do that, but it'll protect your assets and your loved ones. You can't go to a bank and ask for that. Whereas you deal with a licensed, and again, a licensed insurance agent who actually could do all three.
Mhm.
Are they talking about all three with you, or are they just talking about insurance with you? I would encourage you to really determine, because if you can have one reliable source of advice, someone you could trust, someone who will give you all the options, I would definitely talk to your insurance agent about that.
Yeah.
Right?
And that's
Because
a key thing.
that is a key thing, because you're not limited by ABC insurance company if you're dealing with a licensed insurance broker, Phil and I, where we could do all three, and we have multi options for you in terms of companies we can leverage, not just ABC company, right?
Mhm.
So think about that. And at the end of the day, it's all about your money. It's about your money, not about our money. It's about your money that we're dealing with. And so I'd really take a look at what you're doing right now. And if you feel like any kind of fear, we were talking about an advisor who would talk about your risk tolerance, your how fearful are you? Fear really comes from the unknown. That's really what we fear, right? We fear the unknown, uncertainty, right? So think about that. Typically, you're fearful because you don't know. So if your advisor is not educating you about anything, you're still going to be fearful. So deal with an advisor who's transparent and genuine, and who will bring up the things that exist, not just try to hide things. And yeah, there's a certain questionnaire we have to answer for you, but they're going to go through the questionnaire and put perspective, not instill fear in you. And that's what I hated about the banks, because it's almost like the questionnaire was just there to scare clients to just put money into GICs, which is what the banks want, by the way, because they use the GICs to lend money.
Interesting.
So just bringing up the idea that your advisor might have the word advisor in front of their name, but are they?
That's fair.
Very good.
The
All
the
right.
the
This
no
is a
problem.
great conversation, Phil. I think we covered a whole bunch of things here, and it was great because of the season we were talking about. I hope you guys got value from that. Feel free to reach out to Phil or I about clarifying some of the things that you guys have that are still question marks in your head.
Yeah. And if you found this information useful, please don't hesitate to share our channel, because your friends, the people in your network, probably would also find this information very helpful.
Yeah. Have a great